G'day and welcome to this week's video. My name's Robert Gowdy and this week we're going to have a chat about the share market crash that happened last week. Well, that was the perception of one of my clients, that we had a share market crash. Now it wasn't even close to a correction, but the perceptions, because of the media plays the bad news up so badly or so well, that this person think we had a very substantial crash. Now, looking at what happened over the last few weeks, you can see here within a couple of days, I went from the peak here to give us an idea of the magnitude of the loss, and it's just under 4%. And this is a graph that really takes into account 1 month's worth of trading. So very short term, and as I've always spoken about, over the short term there's a lot of white noise. The media plays up the bad news, and yeah, obviously a couple of very big down days like we saw here in this space is definitely newsworthy. But more so, the reason why it's newsworthy is that the bad news will sell papers because it scares the living daylights out of everyone and starts people saying there's been a crash. So my response to this client was, well, there hasn't been a crash, and if you think that's a crash, then you have seen nothing yet. The markets over the longer term have been very buoyant and been very strong in recent times. So this does not represent a crash. A technical correction is 10% down or more. So we're not even close to a correction. And obviously over the subsequent days, then there's been a reasonably healthy recovery. Now, if we start to expand the graph out a little bit more, we can probably start to get a little bit more relaxed to say, well, what do the big crashes look like? And that won't make you relax at all. But you can see here, this is 87. That was huge, down 47% or close to 50%. And this is the bust of the subprime, the global financial crisis, down 50% again. And up here is the 4% that we just saw. So while I said to this client, you haven't seen anything yet, this is not a crash, it's not even a correction. And you can see all the way along that there is substantial, we can put these lines in again to say, right, we're down 15% there, we're down 20% there. There is downturns all the time in the market. Volatility is just the ebbs and flows of the market, and that is purely natural. And at the end of the day, if we were to draw a simple line from here through to the top here, that would cut the tops off all of those big spikes where the market got ahead of itself. And obviously when it gets ahead of itself and there's often a lot of debt that is pushing it up, that's where you get these peaks where people become greedy and they're overpaying, and then the market rights itself and comes back generally too far, but below where it should be. There should be a nice simple line across the whole graph, but it never works that way. That is the share market. So I think the point I was trying to get across with this video is that the markets have been quite good over the last 2, 3, 5, 10 years since the the bottom of the crash here, and you can see that it's bottomed out multiple times on its way to a new record high, which we've only in Australia just seen over the last few months. But you can see that the trend is up and the volatility is normal. Something you should panic about? No, it shouldn't be. You focus on the quality of the businesses and hold them for the long term. And just to further prove that point, if we look back to back to the start of last century, that we've got all these different crashes along the way: 29%, 43, 65, 43, 46, 50%. There's the global financial crisis there, and times it's taken to get back to where it was. So we know that it was over 6 years from the global financial crisis for the Australian market to get beyond where it was. But you can see again, the trend is up, and the reason why the graph over the longer term will always edge up is that it is inherent in businesses and human nature and people that run these businesses to make the business better, to make better products and services, to increase what they provide to their customers, which ultimately will increase the revenue and therefore the bottom line. So again, which I've said before, ignore the short-term stuff, ignore the white noise, Focus on the quality of your investments, of the businesses you hold, understanding what their products are and what their services are, and whether clients value those or not. Clear examples of that is Microsoft. We use, this is PowerPoint that I'm working off. These are phenomenal applications and programs that 90% of the business world use and value and are prepared to pay for. So that's just a bit of a rant on a bit of short-term volatility. It is not risk, it is just the ebbs and flows of the market. That's all it is. Ignore the white noise and keep looking for high-quality businesses. Catch you next week.